Hey everyone, welcome to question 3 of the FIN117 exam. So let's skip ahead to see what the question entails. So part A, so first of all I can see it's split into two parts. So the first part is 12 marks. The second part is 8 marks. So the second part appears to be a revenue-based question, and the first part appears to be more financial instruments, so they appear to be completely different topics. And the reason I know this one's financial instruments is because looking through this, I can immediately see the word bond. I can see bond, bond, bond. So it's all to do with a financial instrument. Okay, so part A is advise Fred of the correct classification of the bond. Okay, so that's how are we going to account for it. Part B is, and it's also explain your reasoning. Part B is consider the balances relating to the bond in the general ledger. Advise what the correct general ledger balances should be. Ignore the impact of impairment. And then C is explain how the impairment on the bond should be calculated and prepare the journal for recognizing impairment, if any. Okay, so let's start off with 1 is advising Fred of the correct classification of the bond. And we'll also read through the question and get the key information. So we're dealing with Nepali, who's a travel company, and they have a large portfolio of investments of convertible bonds. And they actively manage it, and the return on the portfolio is measured based on both the contractual payments of the bonds and the gains and losses from selling bonds. So one bond within the portfolio was purchased on 1 Jan for 7.2 million. And Nepali incurred 50,000 in brokerage costs for this purchase. The bond has a face value of 7.5 million and a fixed coupon rate of 5.5%, which is paid on 31 December and 30 June each year. The bond has an effective interest rate of 6.976% and has a fair value of 7.4 million as at 30 June 2017. On maturity, the convertible bonds can either be redeemed for cash of 7.5 million or converted into a variable number of ordinary shares in Capri Limited of an equivalent value. The number of shares received will be based on the market price on that date. The bond has already been booked in the general ledger by the Treasury team. Below is an extract of the trial balance relating to the bond before any impairment journal entries have been occurred. So we've got bond investment of 7.5 million. Is that right? The face value is 7.5. Interest received is 206k. And the loss on revaluation of investment is debit 100k. In addition, the Treasury team has assessed the 12-month expected credit loss to be 1% of face value and the lifetime expected credit loss to be 3% of face value. The bond was not credit impaired when purchased, and there's been no significant increase in credit risk since 31 December 2016. Fred Quill is the new manager of Nepalese Treasury Department. Fred is a little uncertain about the accounting implications of IFRS 9, the new accounting standard for financial instruments. Fred recently acquired, so they've decided to adopt IFRS 9. Okay. Okay, so for this four marks for the first part is identifying what's the correct classification under IFRS 9. So if we bring up our critical file, and we open up the financial instruments, the first thing to note, and probably the first mark, is observing that it's a financial asset. It's not a financial liability, it's a financial asset. Now, the next question is, how do we actually account for it? What's the correct classification? So, of course, we're going to go to the section classification of financial assets. And we've got this flow chart here, which you would have seen and explained in further details in one of my CSG videos. So, there's really 2 key tests, and identifying this correctly and explaining your reasoning is how you're going to get your 4 marks. So number 1 is the financial assets. Number 2 is the 2 key financial tests. So number 1, choose to designate at fair value through P&L to mismatch accounting mismatch. So that's no. So we want to just highlight our thought process so that there's no choice of doing that. The second consideration is, are the cash flows solely payments of principal and interest on specified dates? The answer is yes, because in the question it's giving us that information that there will be repayments of cash flow on certain dates. So the answer is yes, and there's another mark right there. And then the next test is, are the financial assets held to contractual cash flows? The answer is also yes, because in the question it says it's measured based on the contractual payments of bonds and the gains and losses made from selling the bonds. However, this is a little bit of a trick question because as you see below, the three key areas of classification: amortized cost, financial value through other comprehensive income, and fair value through profit and loss. You can see here that instruments with cash flows that are SPP&I and held under a business model to both collect contractual CFs and sell the assets actually held in this one over here, fair value through other comprehensive income. So it's a little bit difficult to follow. My recommendation is just to look out for this kind of question and review the notes under here before you just follow through the flowchart and accidentally make a mistake in terms of how it's allocated. Read these allocations down below, figure out which one's important and which one has information relevant to your particular case. So in this case, how we're going to get the 4 marks is basically identifying that it's a financial asset, identifying that it's fair value through other comprehensive income, and justifying that because of the 2 tests. Number 1, the instruments are SPP&I, i.e. there is regular cash flow outgoing. And number 2 is that it's held under a business model to both collect contractual cash flows and sell the assets, which we saw in the text up here, both on the contractual payments of the bond and the gains losses made from selling the bonds. So therefore, it's fair value through other comprehensive income. Okay, so part B is 5 marks, and it's asking us to consider the balances at 30 June 2017 and advise what the correct general ledger balances should be. Ignore the impact of impairing. Okay, so from part A, we figured out that it should be recognized as fair value through other comprehensive income. So what the starting point I would recommend doing is going back to your critical file and scrolling down in the financial instruments chapter until you hit this summary measurement of financial assets and liabilities. Now this table gives us some information about how different classifications should be accounted for. So their initial measurement, the subsequent measurement, the gains and losses, and the interest and dividends. So in this table, I've found fair value through other comprehensive income, which is how we need to be accounting for this particular transaction. Okay, so the first thing is that initial recognition should be at fair value plus transaction costs. Subsequent measurement should be at fair value. Gains and losses through OCI, and interest and dividends need to be calculated using the effective interest method, and it's through the profit and loss. So let's consider the existing balances currently. So if we have a look at what the initial recognition was at 30 June 2017. So what I recommend we do as an approach is open up the exam Bible and actually go to accounting for an investment at other comprehensive income. And let's start filling out this table over here so we can figure out what the correct journal entry should be. So let's start off with the headings. So we've got opening balance, principal, repayments, interest, receipts, interest accrued, again, and then closing balance. Okay. So this is the approach I think you should be taking to set up your exam question. Okay, so if we start off with what should have been posted. So we know we bought the bond on 1st of January 2017. So let's just type that in. Now, the opening balance, we need to refer back to the table and actually figure out how we're actually accounting for it. So according to the critical file, under fair value through other comprehensive income, it should be initially recognized at fair value plus transaction costs. So what was the fair value? According to this, on 1 January 2017, now keep in mind we need to recognize it at the point in time, the fair value was $7.2 million. Now we also need to add in transaction costs because we said fair value plus transaction costs. So we're going to go 7.2 plus 50,000. Okay, so the next thing that we want to do is the principal repayments. At that point in time, there was none, there was no interest, and there was no interest accrued. So the closing balance is also this. Okay, the next thing we want to do is what was the journal at 30 June 2017? 30 June 2017. So we know that the opening balance should equal the last closing balance, and we know that there was no principal repayments on this. It's not applicable. What about interest receipts? So interest receipts. So the coupon interest is effectively the interest rate that the bond itself pays. So the the coupon rate is calculated as 5.5% of $7.5 million. Now that's not necessarily a fair value. Face value doesn't necessarily equal fair value, but that's what it says on the bond, and bonds are often issued at a discount to the face value to incentivize people actually buying them. So it's calculated as the face value, which is 7.5 million, times 0.055. But we also need to apportion it for time because we've only held it for half a year. So we're going to do divide by 2. Okay. Now I'm going to put it as a negative because it's interest receipt, so it's an income. Okay, so the next thing we want to do is the interest accrued method. Now this kind of offsets the interest receipts. We generally put this as a positive, whereas interest receipts are a negative. If you kind of consider it, receipts as income, so it's going to be credit. Interest accrued, more of an expense, so it's debit. That's how I think of it. But if you don't quite understand what's going on here, just follow the table. As long as you get the right answer down on paper, that's the most important thing. You can always develop your understanding later on after the exam. So according to the exam Bible, this is calculated as A times EEM, where A is the opening balance, and the EIM is the effective interest method we'll have to get from the question. So let's bring it up over here. So we can see the bond has an effective interest rate of 6.976%. So what we're going to do is we're going to go that times 0.06976. And then of course, same issue, time period, so we divide by 2. And then the closing balance is just going to be A minus C. So we're going to go opening balance minus interest receipts. 7.4. I think I've got the signs wrong. So we need to also take into account the interest receipts there. So it's going to be the sum of all of these three together, and there we have the closing balance. Okay, if we go back to the FIN critical file just to check off where we're up to. So what we've covered so far is we've covered the initial recognition. So we've ticked that off, so we put it at 7.25 million. So we can tick off this column here, the initial measurement column. We've also ticked off interest and dividend because we've accrued interest under the effective interest method, so we can tick off that column as well. What we haven't ticked off so far is the subsequent measurement and the gains and losses. Okay, so the subsequent measurement is going to be at fair value, And the gains and losses, well, that's going to be the difference between what we've got here as the closing balance and what we're remeasuring it to fair value. So we can get the fair value from the question. So let's have a look. What is the fair value at 30 June 2017? I can see in the question over here, it says it has a fair value of 7.4 million. So that means the fair value of 740123, that should be our closing balance now, but it also means that there's now a gain of the difference between the 7.4 million and the 7.296630 closing balance. So if I plug that in, we've now got a gain of $103,370. So if we go back to our FIN critical file, we know that the gain should be posted to other comprehensive income until the asset is derecognized, and then the cumulative amount is transferred to profit and loss. Okay, but we need to stay on track, and we need to get to what the general ledger is going to look like. So the general ledger is a closing balance. They haven't asked us for the journals. They've asked us for the closing balance. So what do we know about each of the different accounts? Well, first of all, let's start off with the bond itself. So we know that the bond investment should have a value of $7.4 million because we've revalued it to that fair value. Okay. We also know that the net profit and loss impact is going to be this one here, the interest accrued amount, the 252,880. Okay, so we know that that's the net impact on the this should be interest received because we're doing accounts, not where it is located. And if we allocate these into debits and credits as well, the interest received is going to be over here. We also know that the fair value through other comprehensive income reserve for that revaluation of the 103,000 is going to be sitting there. So these are the key accounts that they've given us. So they haven't asked us to do every single TB account, otherwise, we'd have a credit account, we'd have, various other accounts in here. All this question wants us to do is to complete this general ledger with the correct balances. So part of that will be putting it in the exact same format. So we're going to have account number, we're going to have 100, for 100, for 200, and then BS, PL, DL, and account balance. So that, once you fill that out, you can provide the correct balances as they should be over here compared to what it is in the existing question. And that's how you get 5 marks for part B. Now, moving on to C, explain how the impairment on the bond should be calculated and prepare the journal entry for recognizing impairment. So to understand impairment, my first response would be to look at the FIN critical file and look through the financial instruments chapter until you get to the section on impairing a financial asset. Now the first thing to note is this only applies for assets which are allocated or classified as fair value through other comprehensive income. So there's some section in here around it. So it's primarily to do with credit loss, which is basically when an entity receives lower cash flows than the amount that is contractually due to it. For example, it's generally to do with a company. Let's say Apple released bonds because it helps with debt funding the company. Now, if Apple's sales go down or it's got a solvency risk, it might not be able to make all of the contractual payments that the bond requires that company to make to bondholders, which would mean that a credit loss might be a justification or the reason for an impairment on the bond, which means the value of that bond would be discounted. Now, the question's asking us, how should that impairment be calculated? And prepare the journal entry. So, as you can see in this area down here, there's a few different approaches. There's general approach, which is applied to most loans and debt securities. There's the simplified approach, which is applied to most trade receivables. There's the purchased or oriented credit impaired approach. And then there's the low credit risk operational simplification. So the most applicable approach here is just the general approach. It's applied to most loans and securities. And there's no information in the question to suggest that this is a low credit risk entity. So you can see the fourth option here is actually that option of simplifying it if it is a low credit risk. So we can rule that one out. The other ones, well, it's not trade receivable, so simplified approach wouldn't be applicable here. And the purchased or originated credit impaired approach isn't applicable here either. So by ruling out the other ones, we know that general approach is the most applicable one. Now the general approach to impairment. So under the general approach, under stage 1, if there is no significant increase in credit risk since initial recognition, entities provide for 12 months ECLs on a gross carrying value of the financial assets, i.e. the face value of the bond. So what that means is we need to look in the question, because there's no significant credit risk, we need to look in the question and look at what the 12-month expected credit loss will be, and then apply it against the face value of the loan. That's what it said over here. We saw in the question over here that the Treasury team has assessed the 12-month expected credit loss to be 1% of face value. So we can use this number here, and basically the impairment value is going to be 1% times face value. The face value is $7.5 million, so 1% of that is $75,000. The journal entry that we're going to post over here. So we'll get date, details, debit, credit. So the date's going to be end of financial year, so it's going to be 2017. We're going to go impairment loss, and then we're going to go fair value through other comprehensive income reserve, 75,000, which is 0.1% of the $7.5 million. 75,000 here as a debit and 75,000 here as a credit. So that's how you get 12 out of 12 marks for question 3, part 1. So let's move on to the next one, which is part B. Alright, so part B. Determine the revenue which should be recognized for this contract in the statement of profit and loss for the year ended. In response, justify your decisions regarding the project bonus to support these decisions with specific reference to IFRS 15. So this is primarily a question to do with IFRS 15, which is revenue from contracts with customers. It was a new standard at the time of this exam. I think they were just testing the students who were across this new standard. So I wouldn't say this is a usual kind of question. So let's read through it. So Clipper has entered into a contract with Deuce. Clipper has not recognized any revenue from this contract. Clipper has a 31 March year end. The contract meets the requirements of IFRS 15. The performance obligations are as follows: 1 year's maintenance for air conditioning, building 1, installation of air conditioning, building 2. The maintenance on building 1 commenced on 1 Jan 2017. The contract price is $2.3 million. The contract price includes a $100,000 project bonus, which Clipper will receive if a complete building 2 installation by 30 April 2017. If the installation date is not achieved, the project bonus is 0. Clipper is waiting on some parts from an overseas supplier to complete the installation and is experiencing some shipping delays. To further complicate matters, the installation must be done in fine weather. Petra, a chartered accountant working for Clipper, has spoken to installation staff and supply chain managers and learns that they are expecting to receive the project bonus. With all the information available, Petra estimates 55% likelihood of meeting the installation date and receiving the project bonus. The installation has not yet commenced as at 31 March. Petra applies IFRS 15 and uses the most likely outcome method to determine variable consideration. The project bonus is material to Clipper. Clipper has summarized the relative standalone selling prices for sales similar to sales to similar customers. These are $1.6 million for air conditioning maintenance 12 months and $955,555 installation fee for larger building air conditioning. Right, so for a little bit of background as to the revenue recognition for contracts clause, new standard under IFRS 15 is there's this new 5-step model, and it's really to recognize where a contract exists and being able to split them out and allocate them by the services that the company is performing, the transaction price of each of the services being performed, and allocating that on a basis, and only recognize it when that performance obligation is satisfied. And that's important for things where you might have a contract to service it, and you might be throwing in another service for free, but that's not the correct recognition of revenue. You need to figure out, okay, what's the value of the service we're providing for free? The value is this, and maybe they're inflating the price of the other service to cover the cost of that. So it's really just looking underneath and seeing what's really going on and allocating it on that basis. That's my summary of what the revenue from contracts with customers standard is about. So it's a 5-step process. Typically, it's number 1, it's identify the contract. Number 2, identify the separate performance obligations. Number 3, determine the transaction price. Number 4, it's allocating that transaction price. And number 5, it's recognizing when that performance obligation is satisfied. Now, that's for non-variable consideration. And what I mean by that is that's consideration that's set out in a contract saying, we will do this by this date. Now, variable consideration is, you probably saw this in the question, is when it's uncertain whether that will be met, and it could be based on a certain objective being met and so forth, which makes it payable. So there's a different way of looking at that. So let's just start off with the performance obligations of the non-variable consideration. So basically this is quite straightforward. They're doing 2 services over here. The performance obligations are, number 1, maintenance, and number 2, I'm going to say maintenance AC, building 1. Number 2 is installation of aircon, building 2. Okay, so the next step is to identify that. Okay, so we've identified the separate performance obligations. The next step is to determine the transaction price. So this is not what is stated in the contract. This is what a free market economy in an arm's length transaction would be placing a price on for this particular service. So in this case, $1.6 million, as you can see down below, would be the standalone selling prices for these services for similar customers. So I'm just going to type them there. Notice how that this combined revenue of the two is much higher than what's being offered in the contract of $2.2 million, which is why this revenue from contracts with customers is an important standard, is because sometimes these contracts aren't particularly clear where it's being discounted, where there's buffers being built in certain areas and so forth. So it's meant to increase transparency in these areas. So the next step is to, we've determined the transaction price, it's this, by service, and then it's to allocate the transaction price. So what we know is the value of the contract is $2.2 million. Now I know it says $2.3 million over here, but I'm only focusing on the non-variable consideration. I'm going to deal with that variable consideration in a moment. So it says the contract price includes a $100,000 project bonus. So that means $2.2 million is non-variable and $100,000 is variable. We're only focusing on the non-variable at this point. So there's $2.2 million right there. Okay, so what this is doing is it's now apportioning that $2.2 million per the contract against each of these services by this standalone selling price. So that's how we can figure out how much revenue should be allocated against each service. Okay, so the next thing to consider is, have they actually met their performance obligation? So if we go back to this, recognize revenue when a performance obligation is satisfied. So very similar to how we dealt with, expenses being accrued when incurred. Revenue must be recognized when the performance obligation is satisfied. Okay, so what that means is, you can pay at any time you want, but the revenue should be recognized when they're actually carrying out the work. So in the question, it says the building commenced on 1 January 2017. And because this company has a 31 March year end, that means that of this financial year, only 3 months can be recognized. And how long is the contract? It's not quite clear, but based on the standalone selling prices for sales of similar customers, it says right there, 12 months for air conditioning maintenance. So really what we should be recognized is, yes, the performance obligations are met, but only for 3 out of 12 months. So then the revenue recognized should only be that divided by 3 times by 12. Did I do it? No, I did it wrong. That divided by 12 times by 3. So that's the revenue that we should be recognizing. Okay, what about the second one? Maintenance of building. Okay, so when did they start on the installation of AC in building 2? It looks like over here, the installation has not yet commenced at 31 March 2017. So they haven't actually started the installation during this financial year. So during this financial year, they can't actually recognize any of this income. So the revenue recognized for this one is 0. So the total for this financial year is going to be 344,348 of the non-variable consideration. Now let's move on to the variable consideration. There's a lot more work on this one. So let's have a look and see what the CSG says on variable consideration. Okay, here we go. Here's the subtopic here, row 172. So it says consideration can also be contingent on the occurrence or non-occurrence of a future event. So variable consideration can originate from explicitly stated in the contract, the customer has a valid expectation, etc. So the entity needs to estimate the amount of variable consideration using one of two methods. Number one is the expected value method, or number two is the most likely amount. Now it does actually say in the question that the Clipper is expecting to use the most likely outcome method to determine variable consideration. It says down here. So what we need to do is assess whether that's an appropriate methodology to include or estimate variable consideration. So the expected value is the first option, and that's saying the sum of the probability weighted amounts in a range of possible consideration amounts. So let's say you might say 10% probable, 20% probable, 30% probable, and then you just times that by the revenue amount, and that's your probability weighted amount. Whereas the most likely amount methodology it's more of a yes or no outcome. You either make it or you don't. So the contract only has two possible outcomes. So you either recognize the full amount of revenue or you wouldn't recognize the full amount of revenue. So that's basically, and that's the method that they've chosen to do for this method. So let's look at the background information in question and see if that's appropriate. Okay, so the first thing to note is just in your answer, just recognizing the fact that under IFRS 15 there is the option to recognize variable consideration either under the expected value methodology or the most likely methodology. And the fact that Clipper has selected the most likely, even though there's a 55% likelihood of meeting this installation. So that's the first point. Okay, the next point here is IFRS 15 requires the assessor, or the person making the assessment, to be constraining in their use of variables. What that means is basically being conservative effectively, and also considering whether it's probable that a significant revenue reversal will not subsequently occur. On the next point, the background information to the question identifies that there is some factors outside of Clipper's control which will determine whether or not they'll be able to make that installation on time, and that's the shipping delays, and it also must be done in fine weather. So it's the variables of weather and shipping delays. These two factors are going to make it more likely or more probable of a reversal in future, which makes it less the argument for the most likely amount methodology is less appropriate. On that basis, if they are going to use the most likely outcome, they should constrain their estimates, because it's not probable that it is probable that a significant revenue reversal will occur. Finally, IFRS 5 defines highly probable as significantly more likely than probable. The standard does not give a percentage, however, it's likely that 55% is likely to achieve this. So the final point on this is that on this basis, the more probable outcome is that we do not recognize any variable component of revenue, and therefore our total revenue recognized for this particular customer is going to be $344,348 for the non-variable consideration and $0 for the variable consideration. And that's how you get the full 8 marks, is laying out your non-variable component in this methodical calculation, and then for the variable consideration, listing maybe 4 points as for the reasons why we're not including any amount. And I've listed probably 5 or so just choose those 4 or 5 out of the list I've given you. And that's how you get a full 20 out of 20 for question 3 on the FIN117 main exam.